Here we are with Eric Valtunas, Senior ETF Analyst for Bloomberg. Eric, it's so great to have you here at the Defiant podcast. Welcome.
Good to see you, my old colleague.
Yes. So if you're listening to this podcast, you probably know I was at Bloomberg News before the Defiant. So the ETF, the Bitcoin ETF has been just the main headline in crypto in the past couple of weeks. And this expectation that there will be a Bitcoin or a crypto-linked ETF has been around pretty much almost as long as Bitcoin has been around. I think the first ETF was filed in 2013 by the Winklevoss twins. Ticker was Coin. It was rejected a few times by the SEC, and then every single other application has been rejected too. But I think the recent optimism is linked to the fact that it's BlackRock making the application. So if you can just get us up to speed on this, the most recent Bitcoin ETF headlines, like why do you think Bitcoin seemed to start a new rally based on just ETF chatter?
Yeah, well, I will say I think the Bitcoin market is looking for anything to rally on. I think there's definitely a high demand for what we call hopium. So at the time, I'm a conduit for what would be one of the biggest bits of hopium there is, which is an ETF approval. If an ETF's approved and multiple ETFs are approved, the main way to look at this is ETF is a bridge to advisor assets. Advisors are typically a little older, and they manage money for wealthy boomers, right? Boomers have well over half the money in the U.S. They own half the stock market. They're loaded, basically. And so these advisors look after their money, and the advisors love ETFs. It's their preferred vehicle in which to do anything, whether it's stocks, bonds, gold. They love the ETF. It just fits in their plumbing. It's easy, it's cheap, it's tax efficient. And so putting Bitcoin in that wrapper all of a sudden just sort of opens up another portal for potential money. So these advisors manage $30 trillion. That's a lot of money. Now, so even if a fraction of 1% were to go into these ETFs, that's a couple $100 billion. So that's the potential here. So I get it. The hopium is, I think, merited. And the big companies involved, like BlackRock and Fidelity, who have filings, as well as smaller companies like ARK, Van Eck, probably missing some people, Bitwise. It's everything from big behemoths to more indie, local, native. Galaxy has one with Invesco that's filed. So all of these companies have massive sales forces, and they're interested in this because they could probably earn a little more fee in a Bitcoin ETF right now, and it's tough to compete with Vanguard in stocks and bonds. So everybody sees an opportunity here. I think the crypto crowd sees an opportunity to get boomer assets. I think the asset managers see an opportunity to get a little fee. Again, it won't be a lot. The ETFs will be way cheaper to trade than Coinbase and those kind of places, but there'll be more of a fee than charging 0.03% competing with Vanguard for an S&P 500 ETF. And then I think the boomers who are interested in this exposure but don't want to mess with some kind of wallet, remembering 12 words for the rest of their life, God forbid they lose it, that kind of stress, I want no part of it. I understand. They would now have a very easy, accessible, simple, one click of a button way to get exposure. So I think this just solves a lot. It helps a lot. It's a win-win. It seems like only additive. And that's what is going on here. So the stakes are high. It's been a 10-year saga, as you mentioned. And who will win, right? There's probably only room for one or two stud ETFs in this category. But many will survive. They'll be in the middle class. A couple will probably close. But that's another question, is the race itself. But anyway, right now, we're probably about 10 weeks out-ish from these being approved and launched, according to our calculations. That would put them early in 2024. We'll obviously amend those as we go, but that's where we stand. So we're kind of in the home stretch. If you look at 10 years, and then you consider 10 weeks, this would be like the last 2% of this story, right? This is the home stretch of a 10-year saga. So it's occupied a lot of my brain, probably too much. I lose my mind on occasion. And I think it's rallying off of this because of all of those implications.
But why is there increased optimism that this time, like these few filings that are in will be the ones that finally get approved?
Right. Two big reasons. One is that the SEC's original reason for denying them got thrown out in court. Basically, a court vacated their decision. Grayscale sued the SEC and won. It was a 3-0 victory. And the court basically said, your reasons for fraud and manipulation don't make sense, especially because they approved futures ETFs that track Bitcoin futures. So long story short, that's a major reason. Another reason is BlackRock entering. This is massive company, adds a lot of stability and even a little potential pushing of the SEC, like, hey, it's BlackRock's involved now. Let's get on with this. And time, I think, over the years, there's been some evolution to all this and a lot of history and learning trial by error. People kind of know how to trade it, what it is. I don't think the interest is as high as 2021. It was like a mania. And then after FTX, everything got like a huge bucket of cold water. But it's kind of, moved on to this other place. And I think the next era will be traditional finance's incorporation of this asset class into regular portfolios, people using it in the same way they might use gold, or even, I would say, something more like, hot sauce, because I don't know how stable this is. But I do know, as somebody who has a boring core, like the Vanguard index funds, which is great, there's probably arguably the best way to invest, especially if you wait 30 years, you make a ton. But it is boring, and you got to do a lot of waiting. So I think Bitcoin gives you a little spice for a vanilla portfolio, and I think a lot of advisors will see that. That's sort of, I think, the evolution that's happened over the past couple of years, which has mattered. But again, I went in priority. I think the Grayscale lawsuit is the most important thing. BlackRock filing number 2, and then just sort of the evolution of things. So that's sort of where we're at.
And the Grayscale case, what was Grayscale arguing?
Basically, it's pretty simple. The SEC approved Bitcoin futures ETFs. And the SEC's logic was, the CME regulates Bitcoin futures, therefore the ETF is tracking a regulated thing, even though the futures price is riffed off of the spot market, right? There's a 99.5% correlation. So the main argument they are making is, how could you possibly approve futures and think that those would be okay and not spot? It doesn't make any sense. Because if there's fraud and manipulation in the spot market, it would clearly transfer into the futures market, into the ETF. Approving just futures was like one of these moves that I think only a lawyer or a regulation person would do. It doesn't make logical sense, but it might make legal sense. But the court saw more logic, and they were like, this is illogical. And that's ultimately what the court said. So they said, your grounds for denying spot on fraud and manipulation is invalid because you approved the futures ETFs, which are the same thing. So they didn't say approve spot, but they basically said your reasoning is no good. And so the SEC then had 45 days to appeal, and they didn't. And the other option they could do is they could come out when the first filing, when they have to deal with the first filing deadline, which would be January 10th, they could come out and have a new reason for denial. They could say, well, we think custody is a problem now. And that was one thing we worried about, was that they could have a new reason for denial. But we are constantly in touch with people back channel. We have been also looking at the documents, and what's been going on is the issuers have received comments from the SEC on the filings, and they've taken these comments and questions and re-edited their filing to make more disclosure, better disclosure, and they file what's called an amendment the more amendments come in, the better we are, because that's like a normal process. Every other time they denied the ETF over the 10 years, it was like radio silence and then bam, a long denial letter. So the fact that they're working with the issuers is a huge deal. Clearly, we think someone up high, probably Gensler, said, let's do this, and told each branch that's involved, figure out a way to make this work. That's what we think. I mean, there's still this, we have a 10% chance still that there could be like a major rug pull. Like somehow they just go, no, we're not ready, and it's a big disappointment. So I'm not saying it's a 100% chance, but the more routine this gets, the better off it is. Because before it wasn't routine. It was radio silence and then this really awful sort of nasty denial, not nasty, but like disappointing denial. And you can understand that 3 or 4 of these denial letters over 10 years, and then you approve futures ETFs, and then you let a 2x futures Bitcoin ETF out, which is BitX. You have to shake your head. And I think all of this points to this just illogical positioning of the SEC. So now they have no legal grounds. The logic looks awful. And so it started to become politically untenable, I think, to keep denying them. It's just too much PR risk now to come out and be like, oh, yeah, here's this new reason. Let's move the goalposts. So anyway, I think all of that is put pressure on them. And it's the easiest path for them, to be honest with you. If you are them, the best thing to do is just approve it and move on with your life. They should not fight this anymore. And the market's ready for it. You know, there are major market makers who can deal with this. There's plenty of liquidity. They've been launching these spot products in other countries right and left, and they've worked fine. We got to see them act during the FTX drawdown days. They did a good job. You know, you'll see the discounts widen a little more than you like, but in a crisis, that's normal. In 2020, bond ETFs had a little bigger of a discount than you like because it's a little stress. So again, but we monitor how well it tracks during bumps up and, you know, crashes, not crashes, but drawdowns that are steep. And it's fine. And in the U.S., there's way more liquidity. So we think those premiums and discounts will be even smaller here in the U.S. So we've long thought they should have done this. So I know they have to take the L a little bit here, but they should. I mean, what else is there to do? So our legal analyst has said that they have very little wiggle room. Those are his words. So, and that's huge because remember, these are all lawyers by training. So the legal aspect of this is a big factor, and so is the political PR aspect.
Super interesting. And so you think that, you know, these amendments during this time are a good sign that things are moving along like any other normal process would? And is it the what commonly happens that the approval comes on the day that the SEC needs to make a decision? That's why you're estimating 10 weeks?
It could come sooner. We still think there's a good shot it comes this year. But, you know, now we're 8 weeks, 8 weeks left till the end of the year, right? So we're now in like the fourth quarter of the game, so to speak. But January 10th is a deadline. So, but it could be type of deal where a leak of the approval comes out in early December, right? And then we hear that they're going to be ready to go by January. But I think we're going to learn a lot in the next 8 weeks. And whether they launch on January 20th, February 10th, or December 28th, I don't know. But I imagine we're going to hear some things coming out over the next 8 weeks that are going to tell us exactly where we stand. So if I had to guess, you know, you and I will wake up one day in, you know, a couple weeks, and we're going to hear they're deciding to move forward, and here's their plan. Because the other part of this is who do they approve first? You know, ARK is the first one up, but I don't think they're going to want to just put one out, because whoever gets out first would get all the money. So they're going to put many out at once. So I think they're going to accelerate the ones that are due in March and April and move those up to the ARK date and put a bunch out in early 2024. I have a stake dinner bet that they're going to come out this year, so I'm hoping it's in December. Either way, we're talking about days at that point. So I think that's sort of how this will play out. But everything about this is novel, unusual, and different. So I just, we're giving our best take as we go and as the information, exists, and it can evolve.
Which ones do you think would be approved first? You said ARK, and would BlackRock be among them?
My guess is they did this with the ETH Futures ETFs, which launched a month ago. They basically said to people, we're going to accelerate you to this date. If you're ready with all your stuff and all your documents, you can launch. So whoever was ready launched. And then I think 2 of them weren't ready on day one. They came out the next day. Might have been 1. But I think 3 or 4 launched. Well, 3 straight Ethers and 4 Ether plus Bitcoin. So 7, I think, launched on that first day. My guess is we'll have something similar. 7 on day 1, a straggler on day 2, and then maybe 1 or 2 just, fade away.
What about this is so unusual? Like the fact that the futures ETFs were approved first and before the spot, or what exactly about it?
Is that unusual? Yeah.
No. You said that we're dealing with a really unusual situation.
Well, unusual in many regards. In there's never ever been 10 years, a filing coming in for 10 years and waiting in regulatory purgatory. When the first ETF ever came out, SPY, that sat with the SEC for 4 years because that was a brand new structure. It was well, what is this thing? So they needed 3 or 4 years to sort of figure it out. This is more than double that at this point. So that's, even the first bond ETF, the first gold ETF, that they took, a matter of months to figure out, maybe a year, not 10. That's weird. Now you got this idea that it's a digital asset. That's a new thing. And it has, some of the politicians care about it. They think it's used for bad stuff. So it's got that whole element too, which you don't really get with gold or stocks and bonds. So for a variety of reasons, it's very unusual for sure. But there's now hundreds of them all over the world. So they provided a good incubator for how it can work fine. It's not a big deal. So, it's unusual, but not really. The other unusual part is approving the futures. We have this thing called the BI ETF traffic light. And that's a system that is similar to movie ratings, PG, PG-13, and R. Certain ETFs have weird stuff going on, and they can produce what I would call a nasty surprise, like leverage ETFs, rolling futures. So we have green, yellow, and red. And it's not to say invest, go up or down. It's just to say, hey, there's a couple things in here that you should know about that are not normal. Like Vanguard's all green. There's nothing to see here. What you get is what you get. But a Bitcoin futures ETF is a red light product because it rolls futures, and that rolling futures incurs costs. So BITO right now is trailing the index by 6%. So that's a lot of cost, a tracking cost that you wouldn't get with spot. So a spot ETF would ironically be a green light. So it's almost like they approved this sort of more dangerous thing before the safer thing. And that's weird too.
It's crazy that it's taken them longer to approve the Bitcoin ETF than it took them to approve the first ETF ever. I had no idea. It's insane.
Yeah. Yeah, no, my first book, I delved into the story of SPY, and even 4 years, the whole culture had changed. They filed it in 88, and it wasn't approved until 92. And, they went from Michael Jackson to Nirvana, everything in culture had changed over those 4 years. That's how long 4 years is. It's a whole college, you can go through college in 4 years. So now we're on 10. I mean, it's a decade. I think I didn't have gray hair when they first filed. So that's how long it's been.
So far, with all the experience and track record that we've had in this time waiting for the actual Bitcoin spot ETF, what's the demand been like? Judging from futures, ETFs, and from spot instruments offshore?
Good, pretty decent. When BITO launched in October 2021, it was instantly the biggest launch ever. It traded $1 billion in the first day and reached $1 billion in assets on day 2. The previous record holder was GLD, which did it in 3 days. So that was big sign that there is a demand. But remember, that was in the mania. It's no longer a mania. So I think it'll be a cooler response short term. But I think over time, you're going to see good growth in this category. I think GBTC, which still exists, which is a private trust, the Grayscale fund, that has $20 billion. So there's $20 billion in something that's not ideal. BITO has $1 billion. There's 21, and then you're looking at people who might have been holding out, for the last couple of years, knowing an ETF's coming. So you add all that up, you're looking at maybe 25, 30 billion in the first year or two, I would think, especially when you've got BlackRock and Fidelity involved. But I think day one, week one, it won't be like fireworks. I just don't see, because what really drove BITO's volume back in 2021 was retail. It was a frenzy. A lot of the volume was small investors, and there was this huge bed of demand just waiting, like a bunch of fish waiting to be fed. Those retail investors either have gone away because they got burned, or they hold the wallet themselves, so they have a Coinbase account. They figured something else out in the meantime. So I think the real new area is the advisor market. And advisors don't go wild on day one. Like they just don't behave like that. So they may do a little due diligence over the first week, figuring out like, okay, which one should we use? What's the cost? Which one's getting the volume? There could be some waiting by some of the bigger investors. So I think we're going to see more of a ramp up than like a massive spike and then like sort of, a little bit of a fall off after that. In other words, instead of looking like this, which is sort of like BITO, it'll probably look more like, and then wave up and down. That's my guess.
Yeah, makes sense. What happens to GBTC if the spot ETF is approved?
Well, they're trying to get the SC to let them convert at the same time. So it's possible GBTC could be part of the whole race. It's possible, I don't know, the SC uses some legal tactic to hold them up because, remember, they might be a little upset they got sued and embarrassed. Don't know. But they're definitely trying. They want to be part of the people who are out on day one. We don't know. It's a subplot that we're also watching, but that's an unknown for sure right now. We don't know.
It's what the market is expecting, though, right? We have a story out today on how the discount has narrowed. I guess people are expecting that will happen. Yeah,
I mean, let me look it up. Last I checked, it was like 14% or something. Looks like it's 11%. Is that right? Let me see. 11%. Yeah, it's about as low as it's been in a long time. So the lower that discount goes, the more people think it will be part of a conversion and into an ETF. But still 11%. If there was rumors it was going to convert soon, that 11% would probably get even smaller. So I think that gap tells you there's still some hesitancy that it might not get converted with the other ones that come out. If it doesn't, it's going to be in trouble because you got to sort of get volume quickly. It's hard to be late on that front, and they're charged 2%. I know I can tell you for a fact the other ones are going to be much lower, like BlackRock, Fidelity. My guess is the average will be somewhere between 60 and 70 basis points, with the high end being 1%, and then they're probably going to be somebody who comes out as the cheap guy at like 40. It might be one of the smaller issuers trying to get an edge on BlackRock. So that's probably the range. All of those is half the cost of GBTC. So they'd have to either lower their fee instantly, and then they got to play catch up on top of that. The good news is they have assets in the fund. So how much they can retain will be interesting if they're able to convert. A lot of unknowns there, like I said, but if they convert and keep their 20 billion, let's just say they somehow are able to retain all those investors, you could argue 20 billion is instantly in this category. right? So that's where we get to that higher number. If they had much less, that's 20 million is a lot of money.
So they would have almost like an instant lead if they were
Yes.
to convert.
Which is why they're so pumped. I mean, they really want to be out there early. The longer they are delayed, the worse it would get. Because say you have a BlackRock or Fidelity fund, and that one starts to see volume and assets, and it starts to seem like it's happening. People stuck in GBTC are going to feel like they're missing the real party. It's like, oh, not only is this liquid, it's BlackRock, and it's 1/3 of the cost of this fund that I'm currently in. I got to get over there. So, yeah, I again,
it's like crucial for them.
It is crucial. I mean, they hired some heavy-duty lawyers, so they know.
So obviously, as you mentioned, like all this speculation that there's an approval coming is driving the Bitcoin price. Do you think that? I mean, I know it's very hard to make this call, but do you think that there's even more room for Bitcoin to rally on ETFs speculation without getting like ahead of the actual money flows coming in? Like, to me, like, Bitcoin is already at near 35,000. I don't know if like the market is getting ahead of itself, like versus how much actual flows will come in on that first week, especially after what you were saying that it's not going to be instant with this being more advisory money. So yeah, like basically, like, will it be a sell the news kind of thing, or are there actual fundamentals to keep driving the Bitcoin price on this?
I would defer to you. I can't give investment advice or do price predictions. All I can tell you is there's probably it's what we saw with BITO, the futures ETF. It was a buy the rumor, sell the news event, right? Because as soon as BITO launched, that was like the top. I think that top hasn't been touched yet, because then after that, FTX happened, and so I think that's still BITO's launch date might be the actual top still. I believe it was like $67,000 or something, right? So we're only like it's half that back, right? I can see it move sometimes on news on this, but overall, what I tell people is I don't know the short-term movements. It's just so hard. There's other variables. How much of it is priced in? Just don't know. What I do know is if you're someone long-term, it's hard to not see a lot of this as just being a good thing, because it's almost like you live in this town and there's a river, and they're also going to build like 5 bridges. You're clearly going to get some more people coming over. You're like, it's just by having a bridge, it's going to help traffic. So I think that's just the way I would look at it. But how much that relates to the price short term, I can't go there.
No,
I don't know, but there's definitely algos and people looking for quick bucks around all this. I try to stay out of all that, because A, I don't know, and B, it's not my job.
Yeah. And then, okay, once the Bitcoin spot ETF is approved, will that just open the door for other spot crypto ETF? Like, will like a spot Ethereum ETF come next?
Probably. There's already 4 of them filed. So my guess is, just thinking how the SEC thinks, my guess is they'll do the Bitcoin first and then maybe look at the Ether ones after, and they might do something like a couple months after. That's probably how it'll play out. I don't know, but I wouldn't look for Ether to launch like the same day as the other ones. I think there'll be like this little gap, because they don't like to get too crazy. Having like 6 spot Bitcoin launch at once is crazy enough. So I think there'll be a delay, but I don't see any reason for them to deny Ether, given they have approved the Ether futures now. It would be like parallel, and again, we go back to possibly even not only illogical, but technically they could open themselves up for another lawsuit. So, but I don't think the first Ether one is even due until sometime in mid to late 2024. So they could probably push it back till till that time because they were filed later.
It looks like Ether futures ETFs haven't seen nearly as much demand as the Bitcoin ones, right?
No, not even close. Let me look at let's look here. Yeah, I mean, 8 million in the pro shares is pretty microscopic. Yeah, I don't know. I've talked to a couple people. I didn't think these would be like a huge hit, but they were underwhelming even to my estimation. And my guess is for most regular people, like I said, all the people who are retail and are going to own this probably have already got it at some point. And advisors just don't mess with futures. They can't stand futures. So like you have to understand, a lot of advisors over the last 20 years have messed around with like natural gas ETFs and oil ETFs, and they've been burned because the rolling of the futures is brutal in energy. Like you could buy USO at like the beginning of the year, and oil could go up 20%, and you're down 10 because there's 30% of roll cost. And so when you have futures in an ETF, it's like spraying advisor repellent on it. So what the Ether futures really tell me isn't that the advisor market isn't going to be there for spot. It tells me that what I said earlier, there's probably not this massive unmet demand for little retail investors for this. That's why I think even for spot, we're not going to see that all the minnows. I think they're doing something else. It'll be much more of an institutional advisor product. And advisors and institutions just aren't going to buy this. And I don't think they care about Ether enough either. That's a whole other part of it. So you've got secondary coin, and with uses futures, which is like repellent. That's really but I will say, if it does show us there's not a ton of just unmet waiting retail demand like there was in the BITO days. I think if these had launched right around BITO, they'd have a lot more volume on day one, week one, month one, because at the time everybody was trying to get a piece of the action. You could just feel it. It's gone. Just much more of a subdued. There's no more mania.
That's super interesting. That it's what you're saying, that in these past couple of years, it looks like retail has figured out a way to get their hands on crypto. Like if an individual investor wants exposure to crypto, they've now they know that they don't need an ETF for it, right? They get it on Coinbase, on Robinhood, like on some other fintech. Maybe they got into NFTs and they're trading it, on their MetaMask. Which maybe is a change from the past bull run. Like, yeah, maybe ETFs will be more almost exclusively for institutions.
Yeah, I mean, the fact that it'll be available on brokerages across America is there'll be some retail. Don't get me wrong, but there won't be a feeding frenzy. That's what we had in 2021. That was a feeding frenzy on BITO. That's over. The good news, though, is that the investors these are designed for, and we just noted this, and I'm going to write a note on it tomorrow, actually, which is the tickers they picked, IBTC, BTCO, and ARCB, are a sign that these are not aimed at retail. These are aimed at bigger investors. Otherwise, they would have picked cuter tickers. You know what I mean? Yeah. Mm-hmm. Valkyries is BRRR, which is definitely a little, but an advisor doesn't want to fool around on the client statement with something that looks stupid. So like if they see iShares, Bitcoin, and the ticker's IBTC, they have no problem putting that on a client statement. But like something that's like HODL or BRR, that's really more for the retail crowd. And so the fact that most of the tickers so far have been, which call them like sober, is good. I think it shows that this is really gunning for that 30 trillion of advisory assets. And over time, one or two will get liquid enough that they'll attract institutional assets and traders and hedge funds because they love liquidity. And if something is very liquid, they would easily use the ETF over any other method to get quick exposure, long or short. To this day, hedge funds love using GLD. They love using SPY. They use ETFs all the time, but they have got to be one of the major, gigantic liquidity ones. They don't go deep in the toolbox. So one of them will rise up to be the liquid one, and that will attract institutions beyond advisors. So that's, I think, what we're looking at. But again, all this is going to take a little time.
So here's something new. Bumper your assets to defend them from price drops without losing upside exposure. You set a price floor and term length, then lock your tokens into the protocol. When your term ends, if the price has fallen under your floor, you leave with stablecoins at the floor value. Otherwise, you just take your original asset back. Benefit from 30% cheaper premiums than options, or earn 3 to 18% real yield as a liquidity provider. Bumper just launched and is offering a share in $250,000 of Bump tokens to early users. About like what you said earlier, demand for Ethereum. Like, do you think that for now it's gonna be is it just Bitcoin that advisors are looking at? Is that kind of just like the depth that they will go to understand crypto?
Good question. So far, it seems like that. I guess we'll see. My guess is, if you look at the global crypto ETFs that are currently out in the world, I think 80% is Bitcoin, 20% is Ether. So maybe we'll see some kind of a ratio like that over time, like 5 to 1. But anecdotally, as I talk to people, it just doesn't seem like that's a big priority.
You mean like crypto in general?
No, like Ethereum. I think most people will view that as like something they don't get. Whereas Bitcoin, there can be, okay, got it, digital gold. Whereas Ether isn't being pitched like that. Although Matt Hogan of Bitwise claims it's going to be bigger. And so I don't know. This is a little out of my, like I said, I would almost defer that to you. But from what I heard and from what the flow show oversees, it should be heavily weighted towards Bitcoin over any other asset.
It's interesting. Maybe Ethereum needs just a simpler messaging.
It does.
Right? Yeah, because right now it literally tries to do everything. I mean, that's what it's about. So, but that's hard to wrap your head around.
And this is important. In time and time again, advisors have generally shunned more complicated things they don't understand. So I think this would qualify as that. Whereas, again, if you're looking at, when you have Larry Fink out there calling it digital gold, that's huge. They all listen to him. So, whereas they might not listen to, somebody who's from that world, but they'll listen to him, and that's how he's branding it. It's very easy to understand, or even if somebody says like a countryless currency, like that's even easy to understand. But Ether is nobody can frame it in a way that just gets it across quickly what it is or why you should own it, in my opinion.
No, I agree. I think the catchphrases that, like Vitalik has, like world computer, is very confusing. Like, what is a world computer? Programmable money is like another one. But I think that also doesn't really get the point across. We'll have to think about like better branding. What do you think the place is going to be for crypto in these like advisor portfolios?
That's a good question. So I'm not sure it's going to be seen as some kind of alternative or flight to quality. In my opinion, this would be more of a risk asset. But, again, I would equate it to hot sauce and otherwise boring 60-40. 60 stocks, 60 bonds, real cheap. You add a couple things on top of that are speculative. And it just, cure your FOMO. You want a little investment in some of these things so you don't have regret later. But I think they would be put on as something that expect some volatility, right? I would not depend on this to hedge my portfolio. I depend on it to do weird things, but that's okay. And so I think they'll use it more like that. Gold is used in a similar way. I suppose it's an alternative because it has zero correlation. But Bitcoin is much more volatile than gold, so I would think it's used more as, again, a little hot sauce, small allocation, just so you can participate and know you own it when you read news about it. That's how I think they're going to use it. I also think there's a bunch of advisors who are concerned they're going to lose their account as the client who's, like, let's say 7 years old, passes everything on to their kids. Well, those kids use that advisor. And they may want to use this as a way to say, hey, look, I'm hip. I'm into the new stuff. And you might see some of that in terms of them allocating to sort of dress up the portfolio to make it a little more modern and youthful. But I wouldn't see any big allocations. Nobody's going all in. I would see just small doses.
So like, I don't know, like 5%, like something
Even less.
Of that order?
Yeah, I would say, 0.5 to 5%, depending on, who it is. But you have to understand, a lot of these people grew up and made a ton of money on the 60-40 portfolio, right? And now they pay no fees on that. It's a beautiful thing. You're not going to eat into that too much. So you might get a small little allocation, but they're not going to sell like their Vanguard fund and put a lot of money in this. They're just not going to do it.
What do you mean they don't pay fees on a 60-40 portfolio?
I mean, if you go to, Vanguard, iShares, Schwab, you can get the total stock market for 0.03%, and you get all the bonds in one ticker now for 0.03%. So, like, you can get the whole. We're talking like 10,000 bonds, 4,000 stocks, and for 0.03%. And it's basically free. It's beautiful.
The beauty of ETFs.
I know. It's
crazy.
It's investor utopia right now. And once you lock into that, it's just that nobody's going to give that up. It's too good of a deal. But they usually have an allocation for some solutions, like, this client needs income, so we'll add a little income, like customizations. And that little 10% window is where Bitcoin would fit, in my opinion.
Is the 60-40 portfolio still working?
Yeah. I mean, you could argue, like, do bonds diversify stocks? Not in 2022, they didn't. But largely speaking, like this year, I think the S&P is up 14%. That's pretty good. 12% went down a little more. And the ag is down 1%. So all told, you're up about 10% this year. That's amazing. The average return for a 60-40 is like 7%, 8% a year. Sometimes it's a little more, but that's a pretty good deal.
Yeah, for like a very, what you would call like the safest bet, like safest portfolio construction. Yeah, like 10%.
Yeah.
Yeah. To wrap up, like, what if you can give like a brief overview of like the interesting trends outside of crypto that you're seeing on like ETF land? Like, what are the most interesting things that are happening? I know it's a very broad question, but for those of us not following kind of the day-to-day.
Sure, I'll give you two. Huge development is that you could now get 5% interest on like a treasury bill, which is the safest thing, or a money market mutual fund, which has a stable NAV of $1, so it can never go down. You get 5% a year in a money market mutual fund. That's a new development. They used to yield nothing, but since rates went up, they now yield 5%. So many people, it's been harder for equities and probably crypto and every asset class to get flows the way they used to. Because if you can make 5% with no risk, you're going to have to work twice as hard as another asset class to get my money. So those money market funds have grown by $1 trillion in the past year. That's a major development and something that has changed the whole physics of the portfolios and flows, and huge. It's boring, but it's massive. And the other one is the return of active. Active had been like kind of pushed aside for like 15 years. It's kind of coming back because it got real cheap. And they're starting to like have active with solutions. It doesn't just pick stocks. It'll pick stocks that are low vol and then write call options on top of it to sort of give you the market, but with a little buffer protection so it doesn't go down as much if there's a drawdown. These kind of legwork package trade active strategies are selling really well. And again, this is the advisor market. These are nervous boomers. And so they're really gravitating towards these more conservative structured products that will help you sleep at night a little more. And that is a huge development also. So those two things I think are pretty good. They come to mind because we write about them constantly. And so, yeah, I would just leave it at that. I mean, unless you had a specific question.
So it's those active strategies, they are still ETFs that let, I don't know, like an investor.
Yeah, that's why you can put almost anything in an ETF. And I very trust the wrappers. People throwing all kinds of stuff in there. But yeah, you can have an ETF that says, do something like this. Okay, we're going to start with the S&P, and then we'll screen out high volatile stocks, and we'll just own like stocks that don't move that much. And then we'll write call options on the S&P a little bit out of the money. So we'll give up some upside, but we'll get a premium from writing those options, and that will be extra yield. So we'll give you like an 11% yield, which helps buffer downturns. It's almost like I would call a package trade. They're doing like X, Y, and Z for you that you could do yourself, but all you do is hit buy and you've put on this trade. And some ETFs hedge the currency in other countries. There's ETFs that go long short. So they're putting all kinds of stuff in there because people love convenience. ETF will do all this stuff and all you have to do is hit buy, right? So it's doing a lot of legwork for you.
Are the fees on those a lot higher though?
Depends on which one, but like they're between 35 and 75 basis points, which isn't that bad because a lot of people are coming from a world where active mutual funds would charge you like 1.1%. So this is less than that. But again, then once you get down to the Vanguard area, 60-40, it's all under 10 basis points now. So I would call that vanilla. But no one's launching vanilla anymore because it's already had. I mean, it's all free now. No point. So what issuers are doing is they're launching things that can be additive to that core or really spicy, like single stock ETFs, thematic ETFs. So obviously the industry is going to move to where it can make some money. And that's why the spot Bitcoin ETF race is so popular because this is something that has a viable spot in a portfolio and you could probably charge a little more than like 3 basis points. And that's where most of the innovation launches and activity is in stuff that would only make up a small part of your portfolio. Because who the hell wants to compete with Vanguard for the core now? When you get lower than 3 basis points, you will make no money.
So things are getting more and more like sophisticated and weird.
Yeah, and solution driven and but some of it sells.
Yeah, no, I bet. But like so what happens with active fund managers if like ETFs are doing the same thing?
Well, luckily the market's gone up so much they still have a good amount of assets, so they're not starving. But over time there will be a culling. They're just not going to be as much money to pay everybody. But they'll still exist. There'll be some that carve out a niche for themselves. But it will probably take a decade where stocks and bonds don't go up a lot. Or they go down. But over the past 15 years, a lot of these managers have lost their client base. So even though the stock market, the stocks they own are like up more, so their assets look okay, the actual clients have migrated to cheaper index funds or ETFs. So they're left with like asset mirage, and they don't have much clients left, and they're going to probably get acquired. There'll be like a consolidation. And every industry goes through these periods of disruption, and we're going through it. The difference in this industry is that as long as the stock market goes up, your assets can like go up enough to offset the outflows. So right now it all looks okay, but like behind the house, there's been like a huge corrosion of like their base. So it's going to get ugly at some point. But like I said, some are already preparing for the future by trying their best to evolve into the ETF market, lowering their fees, coming out with solution-based products. Those are the ones that will probably survive. But the ones that are like still living in 1995, charging 1% to pick stocks, they're gonna die off.
Yeah, it doesn't make any sense.
Ask yourself who would pay for that right now, and you can't find anybody. So I'm a big fan of anecdotal. No one's gonna buy that, especially in mutual fund structure, which has spits out capital gains constantly. So if you wouldn't buy it, and no one else probably would either. So it's not looking good.
Yeah. To like really wrap up now, like these what do you call it, like active strategies? No, what did you the ETFs that like
package trades,
do a lot of the package trades? Mm-hmm. Okay, so they sound like a lot of DeFi products. So there's a protocol. I don't know how deeply you are in decentralized finance, but
shallow.
So there's a DeFi protocol called Yearn, and there's a couple others like that do exactly that. Like they have a sequence of trades that they perform for the user, for the trader. The difference is that it all happens on chain with no intermediaries, using smart contracts, and you do pay like the gas cost, which sometimes maybe it's higher than the 70 bips that you mentioned, but the idea is that like with layer 2s and like other tech, like that will come down way lower, and yeah, like the whole point is like stripping out like all these intermediaries. So I need to throw in my degen question, like in the very, I don't know, long term, or at some point, do you think that the rails upon which all of these instruments are running, and maybe like the bond stocks themselves, will be digital, like will be running on like blockchain rails, like a lot of the backend right now for banks, they've been testing using blockchain. Do you think that has a chance to permeate to all of Wall Street?
You mean like the whole thing revolving around the blockchain and using tokens and stuff? Yeah,
like all of these trades settling on a blockchain, like on a public ledger. Bonds are digital, stocks are digital.
Possibly. I just haven't explored it enough. I know I hear about it though, and it's definitely possible. But the one thing about DeFi that I would say is that I get it, and you want to disintermediate as much as you can. But when it comes to like your personal money and like your kids' college education and stuff, you really want someone to call just in case you have a problem. And if you go too DeFi, there's no one to call. And so I think there'll always be at least one layer where, like the BlackRock, you can always call BlackRock and be like, hey, I'm one of your investors, I have this issue. And you'll get somebody on the phone. If it gets too DeFi, I mean, you know, what are you going to do? Like, just call the blockchain?
You go on Twitter, you write a thread, you wait for a dev to maybe reply. No, yeah, absolutely. I think there's a concept called the DeFi Mullet, where it's like fintech in the front and DeFi in the back. So yeah, I think that's maybe like a viable option for just like the more mainstream who do want to have like a support line.
Yeah.
But yeah, okay, this was a super helpful, super interesting conversation. Thanks so much, Eric, for coming on the pod. And yeah, we'll be looking very closely at what happens in the next 10 weeks. Yeah, will be really interesting to see a very historical decision. Either way, I guess.
Yeah, it should be exciting. Anyway, great talking to you.